When the going is good, you also must understand that things can change. Preparing for the change is very critical. What kind of preparation you need to do? Are you positioned correctly for the emerging scenario? Do you need to do something specific? To understand these things, do join us on this webinar and participate in it to prepare yourself better for your tomorrow in investing. Thank you very much. Friends, in this video for ITHOUGHTWEALTH, I am going to talk to you on the topic dealing with a newly listed IPO. I am sure a lot of you applied to many IPOs and were disappointed you didn't get allotment. Then the share lists on the first day, they ring the bell in their favorite exchange, there is price discovery for a brief period of time, and then the share starts trading in trade to trade. There is a grey market premium that influences stock price on the first day. There is a lot of pent up demand from people who fail to get allotment. They have a feeling of missing out that turns into a fear. Because of this fear of missing out, that FOMO as we call it, makes a lot of people go and buy on listing day. There is nothing new about this. From the time I came to stock market, this phenomenon has been playing out in periods when IPOs are much in demand. When IPOs are not in demand, nobody cares. Stocks tend to get listed almost at the same price as the issue price and sometimes go lower. But when there is demand, stocks tend to list at a higher price and then go even higher. So, we have seen companies list at a significantly higher price over the IPO and then double from there. A recent example is Burger King. You also had the example of Nykaa. There are many examples. I have no particular like or dislike about these companies, but I am just giving these names for examples. But what happens thereafter is that smarter money, which can sell these shares and are holding them because they got firm allotment either as QIBs or as anchor investors, will come later and sell these very shares at higher valuations. Retail investors and those who missed out keep buying these shares continuously and averaging them all the way down. This leads to the stock coming down gradually after hitting a high and waiting for business performance to justify the existing valuation. Now, we all know that the IPO itself happens at a very high price or a high valuation, and then the listing happens at a much higher valuation. Subsequently, the results come out, and with every quarter, the market starts to realize that it has overpriced a company. What does it do? Smarter money sells and moves to a safer place, while retail keeps on buying dips. Now, you also see what happens to these newly listed stocks on television and on Twitter. They create a fan following and they have IR which is working overtime, because a company which comes to a listing today cannot come without an IR agency, and that guy has to do a job. So, he keeps on creating hype in different ways, and there are influencers also who talk a lot about these stocks. I know a lot of YouTube channels also which have exaggerated a number of IPOs based on what they perceive will be the listing price and not based on what is their genuine understanding of the business. All this ensures that the stock price after listing behaves like a hydrogen balloon, goes up very high, or a nitrogen balloon, and then slowly comes down. All this leads to the stock price behaving like a gas filled balloon which goes up a lot initially and then slowly comes down. Now, this is not a time when we should judge the capacity of how high it can go, because however high it goes, it has to eventually come down to reality. This is the way most IPOs work, and this is how retail investors buy all the way up and then all the way down, only to lose patience when the stock price aligns reasonably in sync with its intrinsic earnings potential. And when that happens, most of the retail investors have lost interest, lost patience and lost the capacity to hold, and they sell to larger investors who have been waiting for that moment. So the best way to deal with an IPO is to observe this movement where, like a balloon, it goes up and then slowly comes down, and during that phase you keep on studying results and fundamentals and evaluate what would be the right valuation at which you should buy that company. When you have already arrived at that valuation, you wait. If you get positive reinforcement and newer information which ensures that you must revalidate your assessment, then if you are convinced, reassess the value of the company and say that I am willing to pay more for this, and this is what I think should be a fair price or value for this company. And if you are there, you can start buying. So avoiding FOMO and buying during that initial phase of euphoria is very, very important for every investor. Applying in an IPO is fine, but missing out on the application or missing out on the allotment and then carrying that feeling of missing out into the listing trade is not a sensible thing. In most companies, we will go wrong. I know people will come up with the DMart example, but there are probably 9 other examples for every DMart which don't work as well. So you have to understand that most companies are going to disappoint in the listing trade and after, because the market has always shown a tendency to overvalue these companies, and then it has corrected its assessment of the companies. So apply in an IPO if you must. I would not, but if you feel convinced, you can apply. But if you don't get an allotment, don't chase the stock in listing. Spend your time to form a sensible assessment of what is the right valuation for the company, and at that valuation what should be the stock price. And after you have formed that assessment, keep revising that assessment whenever you get more information on the company. In essence, listing trade is a time to do research. Keep continuing that research. You don't have to call yourself into action and buy simply because you have done the research. Sometimes this research can run into even years, but keep doing it. And if you like the valuation, make sure that you don't miss out on buying a company which you liked when the valuation comes in your zone of comfort. I know all of us will have 50 companies which we like, where the business is very attractive to us and the valuation is not. It is our duty to track all these companies after IPO and keep revising our assessments of the company and sharpening our valuation judgments so that we arrive at the right judgment at the right time to buy the company with the right conviction. That in essence is what I think will make you better investors through the IPO trade and through the listing trade, and that in essence will deliver superior performance for you from every IPO. Thank you for watching this video.